Need cash fast, but tired of all those bank rejections? You've got solid daily sales, but your credit score or time in business isn't exactly perfect. That's exactly where merchant financing can shine. Now, I'm not a CPA, so always be sure to check with one for any tax or financial advice. But today in 2026, merchant financing, including merchant cash advances and revenue-based options, remain one of the fastest way for retail, restaurant, service, and e-commerce owners to access working capital fast. But it's not exactly for everyone, and the costs can add up if you don't understand the details. Today, we're breaking down what merchant financing really is, how it works, the pros and cons, who it works best for, and some smarter alternatives. By the end, you'll know whether it's the right thing in order to fuel your growth. So let's dive in. What merchant financing actually is. Well, merchant financing uses your business's sales performance, not just your credit score, to determine how much you can borrow and how much what it takes to repay it. Instead of heavy collateral or years of perfect financials, lenders look at your revenue consistency through bank statements and credit card processing data. This makes it ideal for businesses with strong daily or monthly sales, but challenges qualifying at traditional banks. It's not always a loan. Sometimes it's an advance on future sales. You get cash now and repay based on a percentage of what you actually bring in. So, main types of merchant financing in 2026. Here are the most common options. So you can get a lump sum and repay a fixed percentage of daily card sales. Payments automatically adjust with your revenue. Similar, but pulls from total revenue, great for service businesses or those with lots of cash check payments. Revolving access to funds you can draw as needed. Fixed lump sum with daily, weekly repayments, often underwritten on sales data. Sell unpaid invoices for immediate cash. Perfect for B2B companies. In 2026, many lenders now integrate directly with Shopify, Square, or your bank for even faster decisions based on real-time data. So how does the process work? What's the step-by-step? So here's what to expect. 3 to 6 months of bank statements are needed, plus basic info, often under 30 minutes. 2, lenders analyze your revenue consistency, deposit frequency, and cash flow health. 3, usually in 24 to 48 hours, sometimes even the same day, you get an answer. You can get cash in your account in 1 to 3 days. Automatic daily, weekly withdrawals that flex with your sales. So what are the pros and cons? The honest breakdown, it's extremely fast funding, flexible repayments that match your cash flow, easier approval with lower credit scores, no collateral required in most cases. It's great for seasonal or variable revenue businesses, but it has higher effective cost, factor rates in the 1.2 to 1.5 range. It can become expensive as sales slow down. Daily withdrawals can strain your cash flow, potential for stacking debt if overused. A restaurant owner typically for one example, a restaurant owner could use it and pay it off if their sales are easily covering everything. But with another business, say they have inconsistent revenue, they could struggle with repayments. So who should and shouldn't use it? Use merchant financing for businesses with 10,000 plus monthly revenue, retail, restaurants, services, and e-commerce, owners needing fast cash for inventory, marketing, or emergencies, companies turned down by banks. It's less ideal if you have very stable revenue and strong credit. Banks are probably cheaper. You need long-term capital. Your margins are already thin. Always calculate the total cost of capital and compare it to the expected return on the money you're borrowing. How to get the best deal? So shop multiple lenders and compare total payback amounts. Maintain clean bank statements, consistent deposits, positive balances. Improve your personal credit where possible. Have a clear plan for how the funds will increase revenue. Read the fine print on factor rates and fees. Merchant financing can be a powerful tool when used strategically, but it's not a one-size-fits-all situation. Understand the numbers before you sign. So drop in the comments, have you ever used merchant cash advance or revenue-based financing? Was it helpful or stressful? If you do need help getting your books in order before you go and apply for one of these things, I am a certified QuickBooks ProAdvisor, and I can help get your books in order and cleaned up. Thanks for watching, and we'll see you in the next one.